Hello, everyone. Welcome to the NT Trading. Today, we're examining developments in the Indian stock market, which have been under considerable pressure due to escalating geopolitical tensions in the Middle East and concerns over corporate earnings. At the close of trading, the BSE Sensex declined by 638.45 points, ending at 81,050.00, while the Nifty 50 dropped by 218.85 points to settle at 24,795.75. This represents a loss of 0.8% for the Sensex and 0.9% for the Nifty 50, underscoring the bearish sentiment that has gripped the markets recently. The broader context is one of heightened caution among investors, particularly as fears mount that earnings growth might slow down. The specter of rising oil prices, driven by the Middle East unrest, has further added to the unease. With these heightened valuations, many investors are opting to book profits, fearing a potential correction. Additionally, India's Volatility Index, or VIX, rose to 15.1, marking its highest level in about a month, signaling the increasing risk perception in the market. A significant factor in this market downturn has been the behavior of foreign institutional investors, or FIIs. Over the past few days, FIIs have offloaded substantial amounts of shares, reflecting a reallocation of funds towards China. With its recent economic stimulus packages, China has attracted increased foreign capital flows, drawing investments away from other emerging markets, including India. This shift is one of the primary drivers behind India's recent market correction, especially as other emerging market peers seem to be holding up relatively well under current conditions. The impact of these FII outflows is visible across the board, with 13 out of the 14 major sectoral indices closing in the red. The sole exception to this trend was the IT sector, which managed to buck the trend and hold its ground. However, other sectors, including banking, energy, and consumer goods, have experienced notable declines, with investors cautious about both the broader economic outlook and the specific implications of rising oil prices for various industries. The sell-off in Indian equities is occurring in a context where the rest of the world is also experiencing turbulence. The conflict in the Middle East, specifically the tensions between Iran and Israel, has the potential to disrupt crude oil supplies, leading to elevated oil prices. As a net importer of oil, India is particularly vulnerable to these price spikes, which can lead to inflationary pressures that may erode corporate profitability and economic growth. Moreover, the rotation of funds into China is part of a broader rotation trade, where capital is moving out of markets perceived as overvalued into those seen as undervalued or offering new growth opportunities. China's stimulus measures have made it an attractive destination for foreign funds at a time when investors are wary of stretched valuations in Indian equities. This shift underscores the current narrative that India is facing India-specific pressures that are not as pronounced in other emerging markets. Looking ahead, the markets will likely remain under pressure as investors weigh the impact of these ongoing developments. Corporate earnings reports will be crucial, providing insights into whether earnings growth is indeed moderating. Additionally, the trajectory of oil prices and any further developments in the Middle East will be closely watched, as they have the potential to influence market sentiment further. In conclusion, the Indian equity markets are navigating a challenging environment shaped by external geopolitical factors, shifts in global capital flows, and concerns about earnings sustainability. As always, we'll continue to monitor these developments closely, and it's essential for investors to stay informed and consider a prudent approach to portfolio management during these volatile times. Thank you for your attention, and we'll keep you updated as the situation evolves.
This video is made for educational purposes only. Please don't make any investment decisions based on it. If you like the video, please like, share, and subscribe. Thank you.